Hello, and welcome to our members and guests for Invest Africa's webinar to explore commercial development and property investment opportunities in Africa. I'm Chantal Carrington, CEO of Invest Africa. Today's esteemed speakers will be moderated by the amazing Adrian Meyer from Charles Russell Speechlys, who is also recognized as a leading individual in the legal 500. Adrian is a corporate transactional lawyer, and he specializes in advising on private equity investments and corporate finance work. He's particularly active in Africa and is very experienced in advising clients on transactions across a number of industry groups and sectors, including real estate. He's an active participant in a number of African-focused bodies as well, including the African Private Equity and Venture Capital Association. So Adrian, at this point, I'm going to hand over to you to introduce the panel so that we can get the ball rolling, because I'm quite keen to hear about how we navigate the needs and the policies, the finance and the risk, to result in the optimal, sustainable commercial development and property investments for the future. So just a quick reminder that there is a chat function for the Q&A from all our guests on today's webinar. So on that point, Adrian, over to you.
Thank you, Chantal, and thank you, Invest Africa, for bringing us all together for this. I too am interested to hear what everyone has to say on the panel of the questions you just raised. So let's try and get into that shortly. But I think thank you for the introduction about myself, which was great. I must tell my children that's what you said about me, so they'll be interested to hear that. I think to give this conversation around real estate, whether commercial or residential or other, in Africa, some context and some focus, I think it's really important to understand where each of our panelists are coming from in that prism. And so I think it's worthwhile and particularly important for today's conversation for probably each of us to have a bit of an intro from each of the panelists. So I'll do that, and then we'll kick into some questions and some discussion after that. So Sam, could I start with you? If you could just tell us a bit about what Vida is doing and what you're up to, and which part of the asset class you're coming at this from.
Okay, thank you, Adrian. Glad to meet everybody who is attending. My name is Sam Kariuki. I'm the CEO of Vida Homes. Vida Homes is a residential platform, a joint venture between Actis LLP, a UK-based private equity firm, and an Indian conglomerate called SPRE, who effectively operates as our technical arm. But I do wear two hats. My other hat is the group CEO for the Garden City development, which is a 47-acre mixed-use development in Nairobi, again funded by Actis, anchored on the third largest mall in the Eastern Central African region. So depending on the hat I'm wearing, then we pretty much cover residential, commercial office space, and retail.
Thank you. That's sort of Eastern Africa, effectively, isn't it?
Eastern Africa, that's correct.
Okay, thank you. And David, what about Kasada and your focus?
Thanks, Adrian. Yes, so I'm David Damiba. Thanks for having me. I am a managing partner and I co-head Kasada Capital Management, where we are really focused on hospitality within the real estate sector. So as a platform, we launched a fund in 2019. We raised $500 million to deploy across Africa. We've established ourselves as effectively the largest investor in terms of hospitality investments across Africa the last 4 years. We own and operate about 20 hotels as of now in about 8 jurisdictions. We have a strategic partnership with Accor of France as an operator of the hotel. So we are hopefully a game-changing platform in the sector, trying to deploy capital across brownfields and greenfields with a team of about 25 people. So kind of a first of its kind in terms of pure play in hospitality in Africa. And the idea behind it in terms of concept was really to come up with a vehicle that could tackle a capital-intensive sector that requires expertise across multiple disciplines.
Thank you. Thanks, David. And Bronwyn, what about you and Grit?
Thanks. And yeah, good to chat. I think from our side, obviously, we are extremely diverse. both geographically and asset class wise. And we have a number of corporate structures, both listed and unlisted, that falls under the ambient of the Brit Group. So from our side, obviously, we focus on commercial real estate. Our entire investment strategy has been to be multi-geographic. So we have investments into Northwest, East, and SADC Africa. And then sort of over time, over the last 10 years of this business, historically have been multi-asset class, but have really started working, which we'll touch on today, is around the creation of specialist substructures or specialist asset classes. But currently are invested across commercial, from offices to corporate accommodation, to industrial, to ICT, core centers, data centers. And the diversity has been great, but obviously very complex. Today, we operate across 12 African countries outside of South Africa, both on the grid side, and then, as you are aware, we have got the development business. So we develop our own properties under GRIA, and then obviously Grit is listed on the UK Stock Exchange.
Yeah, that's great. That's really helpful. Thank you. And last but by no means least, Permenes, can you tell us a bit about how you're approaching it, which is different, I think, to all of the others, in a sense?
Thanks, Adrian, and the panel. My name is again Permenes Marisi. I'm the country head for Rendeva Ghana and the chief operating officer for Rendeva Nigeria. Rendeva Ghana owns and operates 2 projects. City-scale projects. One of them is called Apollonia City, where I'm currently seated, which is located in Greater Accra. And then we have a second project in Takoradi, which is the western part of Ghana. Rendeva Nigeria also owns 2 projects. One of them is called Alaro City, which is located in Lagos. And we have a second project called Jigna City, which is located in Abuja. Rendeva as a group is the largest new city builder in Africa, with operations in 5 countries and with 7 city-scale projects in Ghana, Kenya, Nigeria, Zambia, and the Democratic Republic of Congo. So across the group, our vision is the same. So we are building city-scale projects, which are fully master planned, fully controlled, mixed-use developments, meaning, as you said correctly, Adrian, we cover the entire asset class. So we have zones for industrial developments, for commercial developments, for retail, residential, and recreational facilities. So we cover the entire area. Thank you.
Yeah, that's great. Thank you, Permenes. And I think just following on from what you were saying, I mean, the types of developments that you're doing are touch and concern government and government-led initiatives, given the scale of your projects and the involvement of local and presumably national governments. Could you just tell us a little bit about any meaningful, or how many meaningful government-led policies there are that assist in that kind of approach? Because I'd like to broaden the conversation out to government involvement, but just starting with your sort of city scale projects would be really interesting, and maybe drawing out in the countries that you operate where the governments have had a positive impact and where they can really lead meaningful change for the commercial real estate development sector.
Yeah, so thanks, Adrian. So I think I can say there is a cocktail of incentives that we are able to get from the various markets we operate in. They vary in scale, of course, but some of the key incentives I think we are getting from most of the governments that you operate in is support in terms of building the key supportive infrastructure. Because of projects like the ones we are building, although we are taking care of all the infrastructure within the projects, we need to be able to connect our projects to, of course, the wider society. So, of course, most governments across Africa are investing heavily in building road networks, drainage systems, which are connecting to the projects that we have. And that gives us and our investors the ability to be able to easily access our projects. The other, of course, incentive, of course, that governments are doing so well in terms of investing in reliable supply of utilities, because city-scale projects like ours need very reliable supply of power, water, telecommunication services. So there's been a very coordinated and deliberate effort by governments across Africa to be able to, of course, invest in enhancing capacity of supply and distribution networks for these key utilities. So this is really making it easier for us. For some of the markets we also operate in, Adrian, we have some financial and non-financial benefits, which you also get from government institutions. I'll single out, for example, Kenya, where our Tatu City project, which is the flagship project in Rendezvous East, we are the only operational special economic zone. What that means is that we're able to get some financial benefits, like, for example, tax-related benefits, where the operators or the businesses that operate within our zone are VAT zero-rated. They pay lower corporate tax and other, of course, financial benefits. Apart from that, of course, there are other benefits that are non-financial, like, for example, autonomy in terms of planning. So we're able to have a one-stop shop where all approvals and permits are issued within the zones that we operate in. So some of these benefits accrue across the projects that we have, but some of them are on a smaller scale. But I can be able to mention that these are some of the things we are being able to get from government. There's also another element of course, security in terms of supporting the projects we are building to get that strategic security support from government. Because as we've said, most of the developments across the continent are actually suffering because of insecurity in some of those markets. So we are able to get a lot of government support in terms of dedicated security support to the projects that we have across the continent.
That's very interesting. And when you think about this type of projects you're doing, you need that level of government interaction, and it's so important, particularly around the infrastructure connectivity. In terms of how that applies across the other asset classes that our other panelists represent, I'd be interested to hear about whether that utility connection or the government-led support around utility connection is actually borne out in the other projects that they're operating in, or are the providers of those utilities generally private or government-led suppliers? Because you all need power, light, water, road infrastructure for the developments you do. So perhaps Bronwyn, we could start with you if you've got any thoughts around that.
Yeah, so I think, Adrian, that's exactly. So if you look at, and it obviously, because we operate across a variety of different geographic countries, I mean, I think every country has its different nuance. And you have countries like Morocco, somewhere like Casablanca, where the infrastructure obviously is actually sort of far ahead of a lot of the other countries that you're operating in, very much government supported. So when you're looking at putting a data center in, where obviously electricity is an absolute imperative, and securing that electricity for a period of time, something like sort of Morocco, Casablanca is very much ahead in relation into that type of infrastructure. But to the point is, and just picking up now sort of what the Rendezvous guys are doing in relation to actually sort of setting up the infrastructure themselves, and we obviously are involved with them specifically in Tatu City around building top structure. So if we've got a global tenant and we want to build top structure, to be able to partner with a team of people that's obviously very much focused outside of the public sector on developing that infrastructure is absolutely key. So you go into somewhere like Tatu, and the depth of the infrastructure just from every aspect, not just electricity and water, but all the other permutations from road infrastructure, security, all of these other aspects is obviously set up that it actually gives you a great foundational basis to go into some of these geographies. That's why the work that Rendezvous is doing across obviously all these different platforms and across these jurisdictions is actually very interesting to us, and especially to the global tenants who are wanting to build this infrastructure or top structure on top of it. So the development side is actually very interesting because that's why we formed a development company, actually, because we didn't want to just be a buyer of assets, because they don't necessarily exist and the infrastructure doesn't necessarily exist. So having the development company Greer and having a partner like Rendezvous that's doing sort of infrastructure, it's actually a very collaborative and actually bolsters things on a much quicker scale to be able to get the stuff out of the ground and quickly, and the sustainability thereof. So this collaboration for us, and we've said it for years, there should be more collaboration across the continent, our competition, because we all have a role to play. And you know, if you're looking at where real estate needs to be and where it is, I mean, this disparity is huge. So there is a definitive role for all the players to have in relation to building out a platform.
Yeah, well, I'm all for collaboration. I think between the five of us, there's probably something we can do together. We can talk about that at the end, maybe.
Yeah.
Sam, in terms of the residential aspect, you just put your residential hat on. I know you do commercial as well, but on the residential side, around the involvement of government, let's just keep on the theme of government involvement. How is that important to what you're doing? Is it just around utilities or certainty around land title, or is it lots of other things? And in which case, what is it?
Well, it's been, thanks for that. It's been a mixed bag. I concur with what Paminas and Bronwyn have said in terms of sustained infrastructure development, and especially across East Africa, the road infrastructure. I think we've seen in the last 20 years, cumulatively, more infrastructure investment, especially on the roads, than the previous 40 years since independence. And what that has meant, especially for residential developments, is opening up new neighborhoods, greenfield sites for development, because it gives ease access. Unfortunately, not all aspects of infrastructure. I think there's a bit of externalizing certain aspects of infra spend to the private sector. Water and sewage connectivity, for example, remain a challenge. But I would say generally, we've been in the right direction from an infrastructure development perspective.
Okay, we may have lost Sam a little bit.
Specific to housing incentive program in the last 7 years, if I take Kenya, for example, the government has made affordable housing provision very topical. And they've come up with these tax incentives, VAT rebates, corporation income tax rebates for anybody developing a next number of units per year. They've also tried to make it much easier to access the necessary approvals, almost creating a one-stop shop. Not there yet, but I would say in the works. But I would say if I look at the tax framework and the fiscal incentive framework that specifically targets affordable housing, arguably then it's the one area one can say the Kenyan government, and I've seen this for the rest of East African governments, the one area they have directly intervened as a government.
Yeah,
at the moment, it's very, very topical.
Yeah, that's really interesting, actually, and welcome, particularly around the affordable housing aspects.
Absolutely.
David, you probably wouldn't associate government help with hospitality and hotels, given, especially in the same sentence as talking about affordable housing. But could you just talk a little bit about how the role of government in those countries that you invest in around the hotels and the importance of government around that work that you do?
Absolutely. It's actually, yeah, it's quite interesting to hear the other panelists and their interaction. It's almost like the timeline of when government can come in. Obviously, for a company like a Rendiver, they come in so early that government has to be there for the infrastructure. We are obviously a bit later, and so is the grid platform. For us, though, interestingly enough, because of the sector in which we focus on, which is hospitality, our interaction with government is also extremely key to what we do, because we end up intersecting with effectively their tourism strategy, right? Which for countries in Africa tends to be, especially for the countries that really want to invest in it, it moves the needle, it makes a very big difference. It's a provider of not only a hard currency, but also employment as well. So there's a few countries out there that are really creating a lot of incentives for investors like us to come in and invest in the sector in terms of hospitality. And even some countries that we're seeing now as we're developing our platform, who are looking towards partnering with us in some ways and co-investing with us at the government level to build hotel infrastructure, as it will bring in more tourists. So I think we're a bit later down the path in terms of stage, and we're a bit more focused towards the tourism sector. But the same thing happens, that incentives and pushing for green fields that can have tax incentive, import duty, subsidization, etc. So there is a link to that, and we actually make it a very strategic vertical within the firm. But not all countries are the same, I have to say, in terms of tourism. There's some that super advanced, like Rwanda is extremely advanced as a country in terms of discussing with investors, and some focus a bit less on it. But we're seeing a big transition to accepting and understanding the impact of tourism on their different economies. So not the same on every side, but quite important for us as well. Yeah.
Yeah, I think we've covered the sort of whole range of how government could get involved in the various different developments. Bronwyn, just to come back to you for another question, if you don't mind, which is over the last few decades, people have seen that you need to have a view to longer term returns and to get that growth. It just, in spite of that longer term thing, what do you think's gone well in the last 3 to 5 years or last 2 to 3 years in this sector in Africa? Do you think there's some positives to take out of it? Because we've all seen some less than positive news around it.
Yeah, so I don't want to say you gave me the harder question, but no, we generally are more optimistic than most. So maybe there's a good question for us. So I think, you know, what we have seen over the sort of last 3 to 5 years, and as I mentioned up front, you know, we've always been sort of very much led by tenants. So global tenants that have to be across the continent, emerging markets, you know, we want to partner with them from a real estate strategy perspective. So the multi-geographic, multi-asset class, I think, has stood us quite well and has made us fairly resilient, even though we have seen considerable challenges. But I think what the positives have been and what we've seen is, you know, when we start talking around and when we you know, Grit's not specifically talking about substructure or really having specialist asset classes, where we have seen a huge amount of activity or positivity in that regard. And I think sort of 10 years in putting this business together and having a platform now. So, you know, we do our own property management, facilities management, we've got a substantial platform so we can leverage off that. But where we've seen sort of really great opportunities, and I dare say I call it infrastructure real estate, even though I'm loosely using that word. So things like obviously what we've seen on the data center side, and I know that the jury's still out on different permutations of this, but we do still see a lot of opportunity, and that's sustainable opportunity going forward, just around where the gap is and what the real estate need is for today and going into the future. Where we've seen a mass amount of really interesting what's actually really exciting, not just from a sustainability or return, but also from an impact perspective, we've seen this massive drive for call centers, ICT, across the African continent. And it's a fascinating story because over COVID, you had a majority of these jobs sitting in the Philippines, and these US conglomerates have come forward and said they want to move 1.5 million jobs out of Asia into Africa. Now that's transformational. It's impactful. You know, you would have seen us announce a transaction in Ghana recently with the government, whereby we want to bring 250,000 jobs to Ghana. Now, having the real estate to back that type of need, I don't even want to tell you the square meterage because it's probably going to seem impossible and we can build that in our lifetime. But what's really exciting is the fact that you're bringing jobs for youth, you're bringing impact, and also you're bringing the sustainable real estate aspect to sort of the call center. So ICT is very interesting. We built and developed our first hospital project in Mauritius under the Artemis brand. We're doing a second. So healthcare for us is very exciting. You know, having impact industrial warehousing. You know, we've just been backed by the IFC on a Bora substructure for East Africa. So, and the other aspect, which you know that we obviously participate in, is this diplomatic housing. So having these big globals, you know, needing to be in Africa, needing a real estate partner, but also needing a long-term player, because they know that obviously we're in it for the long term. So not only are we building, but we're actually managing and we're owning and we're having the relationship with them into perpetuity, ideally. So whilst we have seen some obviously challenges and things like retail, and we can go down a rabbit hole of all the challenges because, you know, people look at Africa and they see challenge. But actually, I think between the team on the call today, we've actually seen it as an opportunity. The question mark is, you know, not all of us have the luxury of funding and cheap funding. And this is where the age-old question, and you probably will get into it around, I think, one of the sort of what money is available in that. But the opportunity definitively sits there, but what is the price of capital? And that's sort of where we are. We've actually seen the biggest challenge is when we were sitting at all-in cost of funding at 6%, I don't want to say happy days, but life was a lot easier than we're sitting today, close on 10%. So the cost of capital becomes a hurdle. And it's unfortunate because, could the DFIs and a couple of these other guys be doing more? Quite possibly, but these guys have also had challenges historically with transactions. So you also have to bear that in mind. So we probably, Adrian, could talk about this for days, but it's actually fascinating to see, yes, there's opportunity, but how the hell do we roll this out?
Well, that's really interesting. And look, I agree with you, the cost of capital and the financial side, we will get onto that. And I don't want to go onto it too early because we'll talk about it, I hope, at length. But let's just focus on the positives in the last 2 to 3, 5 years since COVID, really. Sam, is there anything on the positive side that you'd like to add to that conversation started by Bronwyn?
Yeah, if I speak on race, I think what I've been seeing gradually is a transition towards an increasingly institutionalized market. African residential markets outside of South Africa have tended to be very uninstitutionalized, very fragmented, primarily family office, mom and pop shops. But I've seen, and it's driven by real long-term validated demand, increasing interest both from local institutional capital, but also from overseas private equity, and that is both on the demand side and finance side and supply side. If I look at the demand side, the last 3 years has seen some entrants into our market who are now willing to do bulk acquisition deals. They've raised long-term capital. They can acquire properties from developers at scale, $10 million, $20 million type transactions and hold for rent. And then, in that way, then they can allow local developers to scale, but also to institutionalize because they come with a lot of stringent ESG sort of requirements. And speaking of ESG, then I think our market is now, gradually but deliberately appreciating the value of going green. And you're seeing even very local developers understanding that there is a strategic imperative to be well governed, but also very importantly to understand what it means to be a green developer, and that is now taking shape as it were. I suppose the government noise, if I may call it that, on affordable housing has made housing as an asset class very topical at the moment. If you land in Kenya, you might imagine that all we do is develop housing. Every noise in the public sphere is about housing. It doesn't help that we are now, unfortunately, having to pay a levy for a new housing fund, but it is that topical. And I would extend that sort of noise to the rest of East and Central Africa, where you've seen government put in very specific measures to address what has been a very cumulative deficit in provision of housing. I think if you look at African economies from at the turn of the millennium, and especially from 2002, we saw a number of changes of government. And the majority of these changes had a very positive effect on GDPs. If I take an example of Kenya, the anchor economy in the region, the Kenyan GDP has grown 10x between 2003 and 2023. That then has meant, incomes have grown, the middle class has significantly grown, and that then has come out with a demand for quality housing. And the estimate today then is that we have a deficit of about 2 million units, and the market requires, and that is growing by 200,000 units per year, and the supply is only 50,000 units.
You're just talking about in Kenya?
Sorry?
You're just talking about in Kenya now when you say that?
Yes, that's just Kenya, and I, my view, and it's well validated because I've previously operated in the residential sector of Uganda and Rwanda. In a way, the Kenyan situation reflects what is happening in the wider Eastern Africa from a deficit perspective. The character of the economies and the trends of the respective economies in the last 20 years and certainly in the last 5 years tend to be somewhat similar. So one can then, in a way, prorate what you are seeing in Kenya from a residential perspective, specifically to the wider region.
Okay, that's great. And David, can I move on to you? And we've heard a few of the positive things that might have been happening in the last couple of years. And without wanting to be negative, I don't think we can have a conversation about real estate in Africa without talking about weakening currencies against the investing currency. So investing dollars or euros in a country where currencies are devaluing historically against those currencies, and with inflation causes its own issues. Could you talk a little bit about how weakening currency against dollars or euros impacts your business? And then we'll ask the same question, I think, to everyone, because it's going to be important for everyone. But it'd be interesting to hear your take on it to start with, David.
Absolutely, sure, Adrian. I think this is one of my favorite topics. This is my 18th, I think 17th year investing in Africa. I've been doing this since 2006, and been dealing with currencies since for quite a while now. And so it's a big it adds a certain dimension to our investing style that a lot of other investors globally in private equity real estate don't have to deal with. And whether you're a European investor or you're an American investor, you don't deal with so much, first of all, FX diversification in terms of the different effects that you have, and also FX volatility. So the vertical in which we're focusing on, the good news is that hospitality does have what I like to call kind of a pass-through mechanism. You're able to, as opposed to some other sectors, the drop in local currency can be mitigated a little bit by a change in local currency price of the rooms that you sell. But that is depending on country and depending on segment. So we're basically running a very complex, multi-dimensional variable table around what happens in currency in a certain country. So it's to make things in a clearer way. If you were to take a specific country, the higher the segment, the higher in terms of segment of hospitality that you go up to, the less sensitive it's going to be to a devaluation, meaning that you have pricing power, and that pricing power tends to be dollarized or hard currency. And you're able to almost transmit that completely. If you go in the lower segment, which is more the economy segment, you're going to tend to have more local or regional guests in your hotels. And that in a country where there's devaluation usually tends to have a little bit more difficulty passing through any sort of hard currency pressure there. So you have to deal with that. How do you mitigate it? You mitigate it through different ways. One of the biggest issues that I've had in my previous jobs investing in Africa was just the amount of people who put the wrong currency debt on the business model that was earning local currency and putting hard currency. So on the leverage side, it's super important to be at least aligned, and then on the aligned, and not only in terms of currency but also in terms of quantum. Leverage tend to be overused in our sector across the continent. And that means that when you stress test a lot of that leverage, it usually would fail. So quantum and currency. And then finally, for us as a specialist in the sector, it's also in the operational side. How are we able to optimize your revenue management around mitigating the risk of devaluation? That tends to be across optimizing your customer mix. How can we tweak our customer mix a bit more towards potentially international travelers, et cetera? So it goes quite granular. It's a lot of the time that we spend is around that. But if you're able to move the needle, you can actually kind of see and mathematically how your pass-through is actually getting better. So I find it extremely fun to do. It's extremely complex and a lot of macro analysis mixed in with the operational micro. But it's the challenge of operating in Africa. But it is manageable over the cycles. It is manageable.
I think that's on the whole a positive message around it, because you've got that sort of natural hedge and incoming money sort of maybe separate to the country, even though you're visiting a hotel. So slightly different for Rendever, I'm sure. Perminas, have you got some thoughts? I'll come to you in a minute, Bronwyn, because I know you will have some views. So, but Perminas, from the longer term infrastructure side, a sort of thought around how historically devaluing currencies works in your context would be really insightful, I think.
Yeah, thanks, Adrian. I think as the other panelists have said, we've had a negative impact, especially regarding to the uptake of our various products within the projects, especially those products that are dollar denominated. We are seeing cases where most of the guys who could easily afford to buy a housing unit, for example, struggling to be able to pay for that housing unit because they have to convert more of the local currency into dollars in order to buy the same value of products. We're also seeing a lot of our early buyers, especially those ones who, bought on a payment plan, let's say 2-year, 3-year payment plan, struggling to make payments, right? Because now they have to, of course, as I've said, convert more of the local currency into dollars to be able to make their monthly installments. So in totality, I think the devaluation of the local currencies has been a very big, inhibitor to both new investors, getting our various products, and also making sure that those ones that have invested in us continue to pay up for the products that they have bought. So it has had a very negative impact. And then on the other hand, we've also seen, of course, the devaluation triggering inflation, which has also resulted in the rise in the cost of construction. So we have a case where there are people who bought, for example, land. They were planning to build their homes. They can't be able to build their homes and complete them within time because the cost of construction has continued skyrocketing. So I think there's a very big ripple effect to the devaluation of the local currencies. And hopefully this can be able to be addressed, because I think with the fluctuations that we are continuing to see, governments need to be more proactive in terms of addressing this so that we don't have a ripple effect across the economies, resulting to a total collapse of the economies that we're operating in.
Yeah, well, we don't want that, but certainly it's a difficulty, isn't it? I mean, Bronwyn, from Grit's perspective, you've got some natural hedge in the sense because you've got diversified assets across various countries, but still thematically, I think across sub-Saharan Africa, there's a general devaluation against the dollar. So I'd be interested to hear from your perspective how you're finding that and how it impacts your business and what you do to solve for it in a sense.
Yeah, so Adrian, so sort of really upfront, I mean, our investment sort of strategy and thesis was to really, work with clients or global conglomerates. I don't want to say that we're fairly resilient, but sort of were able to, one, trade in US dollars or euros themselves. And, we try to remove a lot of that local currency exposure per se, even though you cannot remove it in its totality at all. So i.e. our hospitality tenants, the likes of a Club Med, a Beachcomber, a Lux, these guys operate in euros, they trade in euros, they sign euro leases. So when you have devaluing currencies, our Club Med sits in Senegal, it doesn't really impact the real estate investment case at all from that perspective. And as you know, the likes of the US Embassy signing US dollar leases and you sign with them out of the US, et cetera, et cetera. So one thing we've done is we've mitigated a lot of the portfolio by having actual hard currency leases. When I talk about actual, I mean hard currency leases that are actually underpinned by a hard currency business case, effectively. So US Embassy is a simple one to demonstrate that. However, we do have tenants in our portfolio, especially when you come to the likes of industrial and those type of other sort of sectors that have seen impact and huge impact on this devaluation. And the challenge with that is that you can have these dollarized leases and dollar leases, but if their business model is severely impacted, as we mentioned, the other panelists have mentioned earlier, we've seen what's happened in Kenya. We're very bullish around Kenya specifically. We've got a lot of investments in Kenya. We're doing a lot. But when you look at what's happened to the local currency, then devaluation against the US dollar, you have to be cognizant of the impact of what it's having across some of these operators. And for me, you asked the question, can that be resolved, or the challenge is, yes, it can be naturally hedged through the process. So the diversification, the ability to deal with tenants that are not as impacted by this. But the reality is that it proved to be a big challenge. And then what we've seen the likes of valuers putting a lot of pressure on valuations because of what's happening from a local currency devaluation, because to the point, it just has a ripple effect across a number of sectors in that. So, our strategy is to try and still be very focused on those tenants that are fairly resilient to what happens from a local currency devaluation. We've seen it on the retail guys. I look at our centers in Zambia, they're actually performing really well, but the issue is that the local currency is blown out so severely against the dollar that you're looking at everything from their own operating models. So, you know, it's an interesting challenge, and it can be resolved today. Absolutely not. It's just about trying to mitigate it forward.
At least in Zambia, you're allowed to have dollarized leases now.
100%.
You change it over to kwachas overnight once, I remember a few years ago. But anyway, they moved it back. So that's really interesting. In the context of Kenya, Sam, Bronwyn touched on that. And if you take off your residential hat and put your commercial one on, around the tenancy mix around the malls that you operate in Kenya, it'd be helpful, I think, to explain how the tenancy mix impacts valuations when you've got local tenants paying in local currency in an inflationary environment against a devaluation as well. That'd be interesting for everyone to hear about, I think.
And yeah, to what Bronwyn alluded to, it's been a roller coaster, a 12-month roller coaster on the currency, almost 50% depreciation. But the good news is we are back now to Q1 2023 levels. Question is, how long does it hold? You know, when Bronwyn was talking, I just kept wondering, and especially focusing on my Kenyan experience, much as I might have a dollar lease, to what extent is it really a dollar lease when I need it? And I say that because what I've seen previously, and I've seen that this year, is pressure from the anchor tenants when there is now significant volatility to convert their leases or renegotiate their leases into a local currency lease. Of course, as a property, as a landlord, tendency, of course, is to resist that. But also practically, there's only so much you can resist when you are dealing with an anchor tenant occupying a significant quantum of space. And therefore, there is an element of bargaining power that they are holding. So what I've seen, both on the retail and commercial side, is some pressure from certain certain anchor investors to renegotiate their dollar leases into Kenya shilling leases. And I'm not sure how the experience of Grit has been in other markets. And this is not the first time I'm experiencing it. We saw some volatility sometime back in 2020, 2021. Because previously the Kenya shilling was really a very stable currency, almost at 100 shilling, looked like a permanent sort of phenomenon. Then all of a sudden jumps 20%. I saw some pressures back then again to renegotiate leases into case leases, and especially for anchor and sub-anchor tenants, because they hold that kind of bargaining power. So I would say it's probably a mixed bag. It does help to have the dollarized rent. It does give you some negotiating power, but I would say it's not in itself foolproof. There is a risk that, you know, a particular tenant, a big tenant with some bargaining power, will actually push back in a case where there is this significant depreciation of currency.
Yeah, that's really interesting. Thank you. We're running out of time, unfortunately, but I just want to, but I don't want to, I'm going to eat into our Q&A time just by talking a little bit about changing tack slightly towards development projects against refurbishment projects against brownfield, greenfield sites. And David, I wondered if you at Kasada had some views around that, and I'll come to Bronwyn and Perminas in a second, but just from Kasada's point of view around development risk as against refurb risk, as against brownfield, greenfield. Be interested to hear your views around that in terms of commercial real estate development.
Sure. The core of our strategy is really on the brownfield side. So the core of our typical transaction is the acquisition of an existing hotel, a repositioning strategy driven by, you know, smart capex and smart commercial DD, and then reposition an asset. But as part of the work that we do, because we focus solely on one sector and because we have an institutional approach, we end up doing a lot of commercial due diligence and analysis around certain markets and certain cities and certain nodes. So as part of that market, as part also of our acquisition on the brownfield side, we do gather quite a bit of intelligence where we can effectively map the market and understand in certain cases where a product is actually missing. And if we see that a product is actually missing, And that product could be a 3-star hotel, could be a lifestyle hotel, could be potentially a resort. This is where, in some cases, we feel it makes sense for us to commit capital for development for a greenfield. So there's a few of them that we have in development as we speak now. So it's tactical, targeted ones driven by what we feel on the mapping of the market. We'll do that because we feel like once the product gets there, we could probably gather some sort of a premium and have a sustainable comparative advantage for a number of years. So that's really how we see our prism. But overall, in terms of percentages, we're about 75-80% brownfield and about 20-25% on the greenfield side.
Okay, that's interesting. And Bronwyn, do you have any views on that? And just to answer one of the questions that's come up in the Q&A is around financing as well. So maybe in terms of development risk that you expose yourselves to, and also just touch on how the financing works and how you get your financing, your longer term finance for those.
Yeah, so I think from our side, our development, so historically, there was groups that focused on completed assets, income generation, long-dated leases. And then we saw this absolute need to start developing our own pipeline effectively. And, also if the American embassy comes to you and wants you to develop X, Y, Z, you don't want to be slow. So the whole thing is that over the couple of years, we've also obviously got the development arm. Now, what type of development risk do we take? For us, it's very specific. So one, we've got very specific capital. That very specific capital does dictate the fact that, we cannot undertake a development unless it is fully let up. And also that we have obviously secured tenant. We take very little vacancy risk. That does, whilst is hugely challenging, because as you can imagine, this takes up a lot of time, a long time to set up that pipeline that's adequately leased. What that does allow, going into your funding question, is that when you are approaching your financiers, on the debt side, that you have got a project. So one, our development company has built up circa $500 million of real estate already. So one, you've got the ability that you can execute it. Secondly, you have got that guaranteed offtake, which allows the funding to come in very early and relatively competitive, because you are plugging in, you're looking at cash flows, provided the bank can take a view that your team can develop on time within budget, et cetera, et cetera. So our developments are very much tenant-led, very focused on the strategy of obviously bulking up from a multinational global perspective. And we really are building for the tenants that exist in our portfolio today. So it's a long-standing relationship. So that mitigates a lot of what's perceived as development risk. I mean, a lot of our pension funds have invested in Grit for the dividend and the cash flow. You start talking developments to them and they fall over because all they see is Africa developments and then high risk alert. So we've really had to go a long way to demonstrate to them that we can build it, we can operate, but we've also got the offtake at the back end of this thing, which is obviously very important. So that's really our development philosophy.
Yeah, that's interesting. And Perminis, do you have any thoughts on that? And particularly one of the questions in the Q&A pop-up has been, which markets do you consider the most business friendly for hospitality and residential property? And of course, the work you do crosses both of those ultimately, but also a lot more besides. But in terms of, can you just a quick chat about financing maybe, and sources of financing, but also which markets you see as being most business friendly for hospitality and residential?
Yeah, thanks, Adrian. So we are unleveraged. So what normally happens is that for all the Rendezvous projects, we don't get external funding. So we have our top shareholders who are American, Norwegian, UK shareholders who contribute capital and inject it into the projects. And of course, there's an organic capital injection from the land sales that we make. So most of the infrastructure works that we roll out within our projects are funded either by the shareholders of Rendezvous or the land sales that we make. From the second question you're asking about the most, optimistic markets in terms of the land of the residential market, I think we are seeing a lot of uptake, especially in Kenya. Of course, we talked about the issue of the housing deficit in Africa, which currently stands at about 51 million housing units. I think some alluded to that. In Nigeria, where we operate, we have about 28 million units that is a deficit. Then we have about 2 million in Kenya. We have 2 million in Ghana. We have about 3.7 million units in DRC. So, but out of all those markets, what we are seeing a lot happening in Kenya, I think is impressive. And one of the greatest players that we are seeing working together with the Unity Homes, who are already doing a lot of course, housing units across the entire spectrum, from affordable housing units to those ones that are, of course, targeting the middle income bracket. But the reason why that is happening is because of the special economic zone framework that the government of Kenya has put in place. What that means is that these investors are able to get some very key incentives, especially on importation of construction materials. And this makes these houses to be a bit affordable for the end user. So Kenya, we are seeing a lot of uptake in terms of the residential development. And then to some extent also Ghana is the same, but on a smaller scale because the incentives are not as many. In Nigeria, we are seeing a very slow uptake in the residential asset class because where we operated in Lagos, that is the Alaro city, we are a free zone there. So the free zone regulations mostly benefit the industrial parks. And that's why you're seeing a lot of course, uptake on the industrial side of things. So I think for me, the way to change the narrative, and especially to deal with the huge housing deficit, is to be able to have a very deliberate mechanism in place, especially by the governments, to be able to support the private sector, to be able to roll out more affordable housing units. What we are currently seeing is commendable, but I think there's a lot of work that needs to be done, because if you put it into perspective, if 40,000 people every single day across Africa move to urban areas, which is resulting to the 51 million housing units in deficit every single year, that needs a lot of work. There's a lot of PPP work that needs to be done, but I think from the government side, they need to be very deliberate in terms of coming up with mechanisms that will be able to support the private sector to be able to inject more capital so that we can be able to deal with this housing deficit. So yes, there is some progress that is happening, but the progress is not good enough if you are to look at the kind of deficit that we are dealing with at the moment.
Yeah, I hear you and I understand that. And actually, whilst you've been talking, someone in the Q&A has asked about the challenge around funding developers for affordable housing, and that local interest rates are high and products available do not match the long-term nature of what some affordable projects should be doing. And so the question is, and I think this is one for you, Sam, is how the panel are addressing the issue around affordable residential housing and getting stock on the blocks. Hopefully, and given what I know about your business and what we do together already outside this forum, I know what you're doing. So this is why it's coming straight at you. Is how are you dealing with filling the coffers with, or the production line with stock is really the question.
I think the way I would look at it is to say it's both a challenge and an opportunity. The supply side financing, an opportunity because the business, our business model, and that's generally the model for every other residential developer, is you sell first, then you develop. The pre-sale model then includes taking a significant portion of customer deposits, which up to now, at least, there's no regulation that stops you from applying them towards development. And credible developers then have benefited from that ability to mobilize a lot of customer deposits and therefore reduce the equity ticket size or the quantum of debt that they need in their project. The most extreme I have seen is a project where up to 91% of the construction cost was funded by customer deposits. It was an affordable housing project. And today we work with a model where for every dollar of equity we raise, we should be able to develop a portfolio value of $5. So one can leverage 4-5x, which then has a positive effect on your IRR, because obviously customer deposits are zero interest rate, and also in a way addresses your funding. So we tend to be very capital light in residential. We don't pay upfront for land. If you're coming into our market, any part of Africa, you want to negotiate or structure a land acquisition in a way that you don't pay upfront for it. You want to build a brand and a sales infrastructure that allows you to mobilize as much deposits as possible, and only pre-sale, only start constructing when you hit a certain threshold of pre-sale or a certain threshold of deposit collections, then you can deploy capital. So while to the question, there is of course a challenge of accessing as much equity as we like, but really nobody will ever say they have as much equity as they need, right? But I suppose the opportunity there then is that you can quickly be able to leverage every dollar of equity you raise to mobilize as much customer deposits as possible. And for that reason, then, it's probably the one asset class, the development for sale play is the one asset class where the opportunity for a high dollar IRR is very much also within the control of the developer.
Yeah, that's interesting. Paminas, did you want to address that question, and maybe Bronwyn as well? We've got a couple of minutes left. Bronwyn, did you have anything to add to what Samuel said around dealing with the supply of residential?
Yeah, not really. I mean, we're not on the residential side, so I think he's obviously covered it from a risk perspective. So yeah, I've got nothing to add on the residential side.
I, for some reason, can't hear you, Bronwyn, but keep on talking.
Can you hear me now, Adrian?
Maybe
Adrian,
the
can
one
you hear
thing
me?
I would, oh yeah, sorry, go on, Bronwyn.
Can you hear me?
Yes, we can hear you,
Adrian,
Adrian.
Yeah, we can hear you.
Sorry about that. Don't know what happened. I think did you answer? Did you provide an answer, Bronwyn? I'm afraid I didn't hear.
No, I was just saying we obviously don't deal on the residential side to the extent that Sam does. So I said that he'd obviously covered everything. I was wondering if from Endeavour had anything else to say, but I think he did cover it quite adequately.
Okay, I agree with all of that. Okay, so look, I think we've probably reached a natural pause. And also we've reached time, I think. So I think it just remains for me to thank all of our panelists for contributing and providing their time and brain space to give some information and clarity around this sector in this continent. I think it's really interesting, and thank you so much. Chantal, back to you, I think.
Thanks, Adrian. Thank you to Adrian, Sam, David, Bronwyn, and Paminas. Thank you so much for your time and your effort to share with us your experiences to help us navigate the future of commercial development and property investments in Africa today. Paminas, also thank you for reminding me about my wonderful visit to Tatu City at the time of our Kenya chapter launch in Nairobi. I was fully kitted out in my hard hat and gumboots and experienced it, quite up close. So thanks for that wonderful reminder. And a massive thank you to everyone who joined today to take away these insights, to implement it in your daily life, and to be transformational. So yeah, we've pretty much run out of time, but a quick reminder to join us tomorrow if you are going to be in Nairobi for de-risking green finance to support Africa's future energy landscape. And an even bigger reminder to join us in London on 6 June for the 10th anniversary of our flagship event, the Africa Debate, with the theme of Africa's global role for trade, investment, and leadership, where you can also hear from Dr. Adesina from Africa Development Bank and Minister Mitchell from the UK government, amongst many others. So yeah, that leaves me then to say thank you very much once again, and until next time.